So you want to own a billboard company, rent some empty air above a highway, slap up a sign, collect a check every month from a business that wants eyeballs. That's the whole pitch, and on paper it sounds almost too simple to be a real industry. Here's the number that should stop you cold. The out-of-home advertising industry generated over $9 billion in revenue in 2024, the highest volume ever recorded. One single company controls roughly a quarter of that entire market, and it didn't do it by outspending anyone on flashy technology. It did it by understanding something almost nobody outside this business realizes. A billboard company isn't selling advertising space. It's hoarding a piece of government-restricted real estate that legally cannot be replicated. And once you understand that, the entire economics of this industry stop looking like a simple sign rental business and start looking like a scarcity monopoly hiding in plain sight. Start with the company that built this playbook. Lamar Advertising began in 1902 in Pensacola, Florida, as a regional poster and signage operator. By 2024, it had grown to more than 363,000 displays across the United States and Canada, generated roughly $2.1 to $2.2 billion in annual revenue, and converted itself into a real estate investment trust in 2014, meaning it's legally structured the same way a shopping mall or apartment trust is. Lamar itself says it owns about 25% of the entire out-of-home advertising market. That's not incremental market share. That's one company holding a quarter of every billboard, bus shelter, and airport display face in North America. And the reason it could get that big without a serious rival ever catching up brings us to the actual mechanism behind this business. Here's the part that explains everything else. In 1965, Lady Bird Johnson pushed through the Highway Beautification Act, requiring states to maintain effective control over outdoor advertising along federal highways or forfeit 10% of their federal highway funding. The law restricts new billboards near roughly 306,000 miles of federal aid highway, and on top of that federal layer, nearly every city and county has its own local zoning ordinance controlling where a new sign can legally go up. The practical result, 6 decades later, is that in most major American markets, it is now nearly impossible to get a permit for a brand new billboard location. Cities like Bellwood, Illinois, have simply banned new billboard permits outright. This means the billboards already standing today aren't just assets. They're licenses to occupy a piece of scarce, government-restricted airspace that a competitor legally cannot recreate next door. You're not buying a sign. You're buying one of a fixed, shrinking number of legal advertising locations in the entire country, and that scarcity is the actual source of the pricing power in this business. Now let's talk about what it costs to actually operate one of these once you own the site. A standard static billboard face generates a real, verifiable revenue number. Lamar's own chief executive, Sean Riley, disclosed on a 2025 earnings call that a typical static unit brings in about $3,000 a month. That's the baseline. But the real money in this industry over the last 2 decades has come from converting those static faces to digital. A digital conversion costs roughly $200,000 per unit, and here's the mechanism that makes that number work. A single digital face can rotate between 6 to 8 different advertisers throughout the day instead of showing one advertiser's message 24 hours a day, 7 days a week. Riley's own numbers show that same $3,000 a month static face jumping to somewhere between $15,000 and $18,000 a month after conversion, a 5 to 6 times revenue increase from the exact same physical location and the exact same government permit. Independent analysts modeling Lamar's economics found that after accounting for lease costs at roughly 20% of revenue, sales commissions around 7%, and ongoing electricity and monitoring costs of a few $100s a month, a static to digital conversion delivers approximately a 43% return on capital. That's not a rounding error. That's one of the highest returns on invested capital of almost any physical infrastructure asset in American business, and it's why Lamar has been converting 300 to 500 static faces to digital every single year. Here's where the ownership structure gets genuinely clever, and it's the part almost nobody outside the industry understands. Billboard companies typically don't own the land underneath their signs. They lease it from third-party landowners, farmers, small business owners, families who happen to own a parcel next to a highway on-ramp. This means the actual capital tied up in real estate stays low, while the company controls the far more valuable asset, the permit itself, which is tied to the location, not the landowner. As of 2025, Lamar owned about 11,200 of its billboard sites outright, roughly 3% of its total inventory, while leasing the vast majority. Lamar has also been quietly buying up permanent easements on land it doesn't own outright, locking in the right to keep a sign at that location indefinitely, even if the underlying property eventually changes hands. You end up controlling the single most valuable and scarce piece of the puzzle, the government issued right to occupy that exact stretch of sightline, while someone else carries the property tax bill on the dirt underneath it. But this business isn't invincible, and the industry's second largest player proves exactly how it can go wrong. Clear Channel Outdoor, tracing its roots back to Foster and Kleiser in 1901, spent the 2020s buried under a debt load built up during decades of aggressive, leveraged acquisitions across the outdoor advertising, radio, and live events businesses under its former parent company. By 2026, Clear Channel Outdoor was in the process of going private, retreating entirely from public markets, unable to keep servicing that debt while local advertising, the category that makes up the bulk of billboard revenue, stayed highly sensitive to the exact same regulatory zoning restrictions that protect the industry's scarcity. The same rule that makes a permit precious once you have one, the near impossibility of building new billboards in most markets, also means a debt-loaded operator can't simply build its way out of a cash crunch by adding new locations. Compare that to Lamar, which entered 2026 with net debt at only about 3 times its annual earnings before interest, taxes, depreciation, and amortization, one of the lowest leverage levels in the company's history, and roughly $834 million in total liquidity. Same regulatory environment, same scarcity-driven asset. One operator used conservative leverage to compound quietly for over a century. The other used aggressive debt to grow fast and ended up forced out of the public markets entirely. The permits didn't fail either company. The balance sheet did. So here's the final balance sheet, collapsed into one sentence. A government-restricted, functionally non-replicable supply of legal advertising locations, combined with a digital conversion upgrade path that can multiply revenue 5 to 6 times off the exact same permit, has turned billboard ownership into one of the highest returning, lowest competition real estate plays in American business, but only for the operator disciplined enough to keep debt low while everyone else in the industry over-leverages chasing the same scarce inventory. Lamar didn't win this market by building the most billboards. It won by understanding over 120 years that the sign was never really the asset. The permit was. And once a government stops issuing new ones, whoever already holds the old ones effectively owns a piece of the sky that nobody else is legally allowed to build in.